Investors and traders, welcome to the channel Market Chart Pattern. Today is 9th of February 2025. Hope everyone is having a great weekend. We'll start by taking a look at the key US markets in this video. As always, this video is for educational purposes only. It is not a financial advice. What we are taking a look at is our timing model, and this one is a weekly chart. And we have got some timing coming in towards the end of March. Because it is a weekly chart, we have to give it 2 weeks on either side. So pretty much from the middle of March, I think we have to be watching for a potential turn in the market. And I believe the entire month of March is somewhere we will need to pay close attention towards the timing cycles. Okay, so let's start by taking a look at the US dollar. This is the weekly chart of US dollar, and what we can see is right into this box where we have pretty strong resistance. The market has just not gone anywhere for the past 1 month, almost 1 month now. It hit this level on the 13th of January. In fact, even the week before, 6th of January 2025, and it is in a trading range. Now I'll show you on the daily chart. What is really interesting to watch is, in fact, this 107 level. Oops, there we go. 107 level and the low which came in on 106.77. That is really key. If the market is really weak, then if the lows of this 27 Jan are taken out, then we're looking at ABCD to the downside, and in my opinion, then we could actually see a test of the lows of 6th of December 2024 as well. We were expecting the market to weakness to come in because of the pattern formation, and we had also drawn this shaded region right. We got a top come in on the 13th of January and a bottom in the stock market as well. So top in the dollar, but a bottom in the stock market. Really interesting. And what we have seen is essentially what is a trading range at the moment, but these are pretty big ranges. Look, this is the 3rd of Feb. I believe that's when the DeepSeek news came out, and we saw a really big rise in the US dollar, but it was sold out. And then the following day there was just no follow. There was just follow through to the downside. And now what we are watching is this 107 level is being defended, kind of, and we have this ABCD situation right at the 38.2% retracements 108 level. Now 108 level could be a resistance level, and this is on the hourly chart. We can see we have this nice ABCD getting into this 38.2% retracement. This could be a resistance level, and we could see the market pull back right into this trading range. However, this 107 and 106, this low of 106.77, these are the key levels to watch. More likely the market is likely to remain range bound. Now if on the flip side we take a look at this on the Euro USD, so this is the forex market, we can see that we had as the dollar rose last Friday, we saw a pullback in the Euro USD, and these are the key levels that we were watching. You see this pattern formation. This is when the dollar index made a top on the 13th of Jan. The Euro USD made a bottom. Euro USD is about 51%. It's kind of a mirror image, but it's not 100% identical. And where we are right now, let me show it to you on the 4-hour chart. What we can see is the market actually moved lower as after the non-farm payroll data came out, and the market in the US dollar actually rose for the day. But this is a really key level that we are watching around 103, because we have a potential ABCD and then 61.8% retracement and 1.6 minute expansion of this BC swing nearby. This could be a pretty good support level, and we could see some sort of a rally coming into this market from here. On the flip side, we have seen the ABCD pattern right at the 38.2% dollar index. So most likely there is a chance we could see at least some sort of a bounce in Euro USD, some sort of strength coming to the Euro versus the US dollar. We'll have to wait and see how it'll pan out, but this is how it looks like. And on the flip side, if we break below this 61.8% retracement, then we are going to probably come towards the bottom of this trading range right here. Let's take a look at the British pound. Here we go. So the British pound is also a range bound. One of the key things is for the British pound to really start moving higher, is to get above this 125.50 level, which is the 61.8% retracement. And we have seen nice rallies come into this market. Let's draw a trend line like this. And last Friday, what it has done is it's formed an inside bar formation. And if I just there you go, this is the it had done last Thursday 61.8% retracement. Last Friday it remained inside this mother candle. So I think because we have these rising bottoms, there is a chance we could see further range bound price action in the British pound, and it really needs to get above this 125.50. Then we can say, okay, perhaps we have seen an important sort of a low which has come in, and the British pound could rally a little bit. Now let's take a look at the Japanese yen versus the US dollar. This is one of the most interesting ones. So here we go. And what the Japanese yen has done is USD JPY. So the Japanese yen has actually been strengthening against the US dollar. It has formed this ABCD right into this 78.6% retracement of these lows, and this low. So this is 78.6% retracement right here. We also have a 38.2% retracement of this low to this high nearby. So we have a confluence of three things. We have 38.2% retracement, 78.6% retracement nearby, and this ABCD right here. So this is a region of a pretty strong support. Whenever we have two or more patterns or ratios coming together, we pay really close attention to that particular region. So the last Friday's candle is also pretty interesting, because it is a doji candle, so we need a further confirmation. We ideally like to see a follow through, and if we get a positive candle out of it and it's able to take above the highs of the 7th of February to the upside, that will be an interesting one to say, okay, perhaps we are getting this market where it is starting to perhaps rally. So the US dollar strength could come in, and I would imagine this is the gap formation that we're looking at. Perhaps it could go and fill this gap, so it could get into this gray shaded region. That remains a possibility. So this one is a very interesting currency pair to watch, and the reason it is really also really interesting is because of the link with the treasury market, and especially the 10-year treasury note. So I'm going to show you this TNX, because in the previous videos we have seen the correlation that exists. So let me actually try to show that again. USD JPY, here we go, and let me get TNX but on a different pane. I don't know why it is not let me do this. USD Japanese yen and TNX. Oh yeah, I'm sorry, I need to click on this and then have it in a new pane. There we go. So you can see the kind of correlation that exists between the 10-year treasury note yields and this currency pair USD JPY. So we saw the top come in, and then we saw the yields actually put in a top as well, and the yields pulled back. And if the yields are going to rise, which looks like the yields will start to begin to rise, and I'll show you that in a moment, and then we could expect that the USD JPY, is the US dollar, is likely to strengthen against the Japanese yen, or the Japanese yen is likely to weaken. So that's the correlation which exists. And if we just go and take a look at the 10-year treasury note right here, and here what we have is this ABCD being formed right at the 61.8% retracement, very close to that. So we have confluence of two things, and then we also have the symmetry come in right here. So we have got a confluence of symmetry, the ABCD, the 61.8% retracement right here, and then we also had a positive close last Friday. I do not like this upper wick, so I think there was some sort of selling that came into it. But it is indicating that perhaps we have a turn, and we could see the yields for the 10-year actually rise, and the 38.2% retracement on the entire high to low assuming this is the low, come in around 4.55. So we could imagine the yields rising to 4.5%, and the 38.2% is from here. So 4.5% to 4.55 percent is likely for the yields to rise to. And if it's able to get above this 38.2% retracement, and then the yields will rise even further. And if we were to take a look at this on the price chart, so we'll take a look at this through the help of the 10-year Treasury note futures. Here we go. So we have this market symmetry come in, and this is the previous rally, and this current rally was exactly the same in terms of magnitude. And not only that, if we just count the number of bars, so we just start counting the number of bars. I've used the tool which is available in TradingView. We get 14 bars or 21 days. I would imagine these are the actual calendar days, not just trading days, because the bars are trading days. And then we take this low right here, and then to this high right here, which is gonna be about 15 bars. So we have a really nice time symmetry as well. And now you could argue I could even take this one, so it's just gonna be out by a couple of days. The reason I did not take this one is because it closed lower for the day, and this one is actually a positive close, so a little bit of arbitrary judgment used. The other really interesting aspect is that last Friday the market had the exact number, 38.2% retracement from these lows right here. So that was a very, very interesting development. So if you take these highs and these lows, came in right at the 38.2% retracement. We have the symmetry in price, we have the symmetry in time, and when we have the case where price meets time, the pattern is complete. So I think we are likely to move lower in price for the 10-year Treasury note. In other words, the yields to rise. So this is what we'll be watching next week. And rising yields, they could have impact on risky assets as well, because it just indicates the interest rates will be rising. So this is what we are watching here in 10-year Treasury note. Let's take a look at the shorter end of the curve, how it is doing. So this is the 2-year Treasury yields, and you can see that last Friday, strong looking candle closing above the 20-day moving average, and the 89 period moving average just below that. We were thinking that it could get down to about 4.13 because this is where the symmetry is, but it's actually stronger. So this is indicating it's got further to go to the upside. It's a shorter of the curve, the yields are likely to rise as well. And if we take a look at the long bond futures through the eyes of the 30-year Treasury note on the futures, let me actually bring it here so everyone knows what we are looking at. So the market went a little bit above the symmetry, but right into this strong resistance zone that we had drawn from before. So we had a 61.8% retracement come in from this high. So it comes in from this high to this low, and we also had a 38.2% retracement come in all the way going back to the highs of 17th of September 2024 to the lows which came in on 14th of January 2025. So we had a confluence of two retracement coming together with symmetry nearby. It's always a region we pay really close attention to, and we have seen the market actually move lower. And if it's able to, we get a follow through, that just indicates on the longer end of the curve, the rates will be rising. This is what it'll indicate. And the other thing is that you can see that this market is really, really bearish. Whenever we have had pretty nice massive rallies as well. That was a very nice ABCD, which is visible on the 10-year, not so much on the 30-year long bond futures. We have seen these rallies actually fizzle out. This is just because it's in a bear market. And if we were to just take a look at TLT, which is the ETF with 20+ year duration bonds, is going to be a similar scenario. I have not drawn here, so I'll just draw this one because it's going to be very similar to 30-year. There you go. So the market symmetry, which is the bearish symmetry in this case, still exists here, right here. So this is what we are looking at in the interest rates, and the correlation that I've shown you with the USD JPY. This indicates that actually the dollar is likely to strengthen versus the Japanese yen, or the Japanese yen is going to weaken versus the US dollar. So it's going to be an interesting currency pair to watch next week in particular. Now let's take a very quick look at the metals. So we'll take a look at the gold market. This is the futures chart. This is COMEX gold. And what the gold has done is it broke out of this dynamite triangle. And one of the things about these triangle patterns, which I like to call um, dynamite triangles, is because when they break out of this on the downside or on the upside, it's a pretty explosive move, and this is what we saw in this case. And it's gone right into this 1.272 projection, extended projection, and right into the 1.272 expansion of this entire range that we had saw. A little bit of correction we had from 31st of October right into 14th of November last year. Right now it's just kind of consolidating right in this region, but I would imagine there is some resistance available in this entire zone between where it is now and the 1.618 expansion right here. So nearly around 3000 level on the futures chart. On the so what we should do is watch for further price action next few days, because it's right at these key levels, and if we begin to get some confirmation from the price action, for example moving below the low of last Thursday, we could be in a situation like this where we get some sort of a pullback. That remains a possibility. And if we just take a look at the spot market right here, so different kind of a pattern, but again it's also right at the 1.272 expansion right here. And if we just take a look at the silver futures, this is the COMEX silver. It also broke out of this larger triangular formation, but the move just has not been as explosive what we have seen in gold. So the gold is actually much stronger than the silver. And the other thing is it's just done this ABCD right in the 61.8% retracement, and over the course of last week it has pretty much gone nowhere. And in fact last Friday candle was the silver was down nearly minus 1.5%. So fairly different to the price action which is in gold. That's another reason to be actually be careful in terms of the metals, because of the potential strength which would come into the US dollar, and also as the yields begin to move higher as well. Okay, now let's take a look at, now we'll go and take a look at some of the global equity indices. This is the German DAX. German DAX has been very strong. The chances are you could get to 22,183, or roughly 22,000. It's just not too far away. And if we take a look at the FTSE 100, it has completed one of our first targets. Now I think it could even make an attempt towards the 8800. Yeah, it wasn't too far from it, so maybe there's a possibility it could do that. Let's see if it is able to do that. I see a potential pattern formation right here, which looks more like a 3 drives to a top, but the problem is that I would really like to see 3 drives to a top take place underneath a a previous high, because here it is making new all-time highs. So here we go. So we do have something like this. There's a possibility of some sort of a pullback to happen. Here we go. And last Friday we did see an inside bar formation, just because you could call it a wedge as well. So it is just like a wedge drawn, this. So it's kind of a wedge formation like this. It looks like more like a parallel channel on this one. So we'll just be watching this one carefully on the FTSE. And then if we take a look at the US equity markets, let's start by taking a look at the cash S&P 500. And here on the cash S&P 500, here we go. One interesting thing to note is 24th of January 2025, we saw the market close negative on Friday. Over the weekend, I believe there was the news about DeepSeek. The market opened with a gap lower. The cash market is actually closed higher for the candle formation, but look, it was such a big gap, but there was just a follow through. And then the Friday, 31st of January, the market was down about a 0.5%. And then over the weekend, we had the news of tariffs come in. The market opened with a gap lower. The futures were quite a bit lower that day. Again, there was just no follow through. It went right towards the 61.8% retracement. Didn't reach it exactly on the cash market and the 1.272 nearby. There was just no follow through, and then we saw a retracement. And what this retracement has done thus far is it just retraced this 78.6% retracement, and again the market has closed on the Friday lower by nearly about 1%. So we have this kind of a descending highs right here, which more kind of look like a parallel channel as well, but you know, moving lower, descending down. So it'll be really interesting how the market will open and whether we will get some sort of follow through or not. But the market really needs to get on the cash basis above 6100 or 6090 on closing basis for it to go and complete this ABCD pattern that we're watching, where the market could go anywhere between 6270 to 6300. For this pattern to remain intact, the really key part is point C, which is the 3rd of February 2025 low. So as long as that those are held, you know, we could still see higher prices because of this ABCD pattern formation. So the first target will be around 6190, and then anywhere between 6280 to 6300 is the kind of the potential for this market to move higher to. And if we just move over to the weekly chart, what we can see is we have this chart where we have these number of these price projections, or ABCDs, this is how we like to label them. They have come in confluence. So this big black one and this smaller black one, in the extended CD leg of this blue pattern right here, and the market kind of put in a top last year on 2nd of December, and then a new high was formed on 21st of Jan. But you can see the market is just sideways, it's just consolidating right here. The 20-week moving average is really holding it. Whenever the market gets to it, it just pops back up. It remains in this zone where it seems to be a fair amount of supply, and just because it is such a strong it was a target for us, so really happy that we achieved the target, but it could also turn into resistance. And just because it's such a strong level, it is taking a market you know, a couple of months already to be able to just remain range bound and maybe eventually build the kind of energy it needs if it needs to break to the upside. And this is where we have the shorter term upside targets that we discussed on the daily chart. Now let's take a look at the S&P 500 on the futures. We have similar kind of pattern formations right here, and you can see that the market is just sideways. And on the shorter term daily charts, here we go. We have that pattern available as well, which we discussed on the cash market. So you can see just like 1 2 3 4 5 1 3 5, a descending kind of a channel formation. Market closed below 78.6% retracement. Key remains 3rd of February low, because that is point C for us. And then on the futures, we could see 62.45, maybe even as high as 63.60 or 63.50 roughly as well. So let's see what the price action will look like over the course of, for example, next Monday. Quite bearish looking bar. Market was down about minus 0.73%, but also sitting right at the 20-day moving average, which could also provide support. Now I've not drawn the retracement level. Let's just draw the retracement right here to here, because it does look like the market closed right at the 38.2% retracement. So there is in fact pretty good support coming in from the moving average, and 60.50 being the 38.2% retracement of the lows of 3rd of Feb. So there we go, we have pretty good support there. Let's see how the futures will open. Now let's take a look at the Nasdaq. So we'll take a look at this on the Nasdaq NDX, which is the cash index, and here you can see that the market is closing below the 78.6% retracement, just not able to get above that. So the market needs a bit more strength. It was down 1.3% on the cash index, and on the weekly chart, I'll show you the pattern that we have been keeping track of is this one. Where we have the CD leg, which is the extended AB leg by 1.272. So the CD is 1.272 times the AB leg. And you can see the really nice channel formation right here. Whenever the market has come in and tested the lower boundaries, found support, move, boom, boom, boom. There's a potential maybe it could go and hit this 22,700 level, maybe a little bit higher as well, so 23,000. We'll have to wait and see. 20-week moving average is nicely providing nice support as well. But any pullback possibility remains for the bottom of this channel to be tested. The way it happened on 5th of August, it was a really, really strong move to the downside, which started around the 11th of July. In a few weeks time we had a pretty good 15% retracement. Now let's take a look at this, but on the futures chart, here we go. On the futures chart we can see that with the extended CD leg for the ABCD, I could actually see us go 23,250 perhaps for a number of weeks, more than a couple of months now, around a couple of months actually, a little less than a couple of months. The market is just range bound after hitting our key level of 22,000. That's that this is what we had forecasted back 7th of November when the election results came out. We had a key turn date coming out as well. Long-time subscribers will know about that one. This is what we are watching on the futures on the weekly, and if we just take a look at this on the daily chart. On the daily chart, one thing I would like to point out is this key date. This is when some news came out. I don't know exactly what that news was. The market was down about minus 2.75%. So we said, okay, we'll wait and watch for a follow through. We did not get any follow through, and the market has been range bound, but still bound by the 78.6% retracement. And now on some previous occasion, on the 6th of September 2024, this market was down about minus 2.89%, but there was no follow through, and we saw a nice trend to the upside resume. And on the 5th of August, this is when the capitulation actually happened. The market was down nearly 2%, or minus 2 standard deviations, and this move, the 6th of September, was actually minus 3 standard deviations. It's a very, very rare move, and if there was any follow through, that would be pretty dramatic actually. Then the market could have could be much lower, but there was just no follow through. So this is why we really want to watch for the follow throughs whenever we get a move in excess of nearly about 2.25% and plus. I think the wise thing is to actually see whether we get some sort of follow through or not. And then 25th of July 2024, the market was down minus 1.43%, or 2 standard deviation, and we did get a follow through this time though, as it was part of the corrective ABCD leg. And then previous to that, the 31st of May, the market was down okay, so I think I have it marked as minus 2 standard deviation, but that was intraday, but there was just no follow through, and we had a nice resumption in the uptrend. So always good to watch for follow throughs whenever we get these really extended declines in NASDAQ. Let's take a look at the Dow Jones Industrial. So the Dow Jones Industrial actually made new all-time highs on the futures on 31st of Jan. So it's an interesting development. It's just range bound for this market. The really key thing is it's 44,000 roughly. It's finding really nice support from the 38.2% retracement. Going below this, we could have an ABCD. Maybe it could pull back a little bit further, but also in relation to the left hand side, there is this structural resistance. It's just capping this market right now, but on the weekly chart it is also right into this zone that we had drawn way in advance. And if we are in the CD leg higher, maybe there is a further upside as well. But watching this is just range bound right now on the weekly chart, on the daily chart. And then last but not least, we'll take a look at the Russell 2000 small cap. And you can see that the small cap has actually also gone, it is also range bound right here. It remains slightly above the 38.2% retracement, hugging this 20 week moving average, but a really range bound price action on the weekly. And then if we just take a look at this on the daily chart, here we go. You can see that it basically retraced about 50%, but it's just gone nowhere. So it still remains, in comparison to some of the other indices like S&P 500, remains weaker, and remains more range bound. This 61.8% retracement, which came in from the lows way back on 5th of August 2024, is still kind of providing the support. I'm actually going to clean up my chart a little bit so it's easier to see. And here we go. There we go. So it just remains range bound, but also finding a lot of supply right at the 50% level. So this is what we are watching in these key indices. I think the key thing for this index is this 3rd of Feb low, and in particular this 13th of Jan lows for all these major indices. As long as these are held, I believe we could see range bound behavior, and with the possibility of our ABCD to the upside being achieved in some of the indices where we are watching for those levels. So thank you very much for watching the video. Good luck, good trading, and if you happen to like our video, give it a thumbs up. If you learned something, you found it of educational value, then please do subscribe to the channel. And if you do, then hit that bell icon button. That way you will know when the new videos are posted and you will not miss on anything. Again, thank you very much for watching the video. Good luck, good trading, and speak to you guys soon.